I'm Alok Chaturvedi, derivative head in Paytm Money. We are doing this FNOP Chacha from so long, so almost every week we are planning to do that with some good speaker who have already done that. This time we are very fortunate that Raghunath has joined. So people who have already coming from the options trading background, they probably know him very well. Just to give you the perspective that there is a platform called Opstra, right? So it is one of the awesome analytical platform for all the options trader, right? So he's a founder of that. Okay. So for the newcomers, guys, there are several option analysis you probably doing in your daily routines, right? And now onwards, there are multiple platform available where you can get all this data, right? But Raghunath is way back created that platform, and you have such an awesome data analysis as an option trader. You'll get everything over there, right? So that's the best part. Even I have used multiple times now. I'm right now also using, right, just to explore what we can do better for our users, right? So that's the introduction from Raghunath. I mean, I don't have words. He's you know you can just talk on and on for the option trading with him, right? So he's here to give him his insight about what he did in his life, how the option trading look like as an overall market, what we can do with what are the there are few obviously there are few fundamental question we'll ask, there are few deep insight from a trading perspective we'll ask, right? Apart from that, if you guys have any specific queries related to this, you can obviously raise anything. If you want to know about Opstra or know about particularly option trading, you can raise it, right? He'll happy to answer, right? So Peter is our product manager from the derivative team only from a Paytm Money. We are waiting for Shanka. Shanka is our educational coach basically. He is a trainer who provide all kind of training within Paytm Money ecosystem. And this is one of the extension. FNP Chacha is one of the extension of that. We just want to educate our users. We just want to empower our user so that they can actually get the knowledge. They can actually get the data, and based on their knowledge and data, they can actually trade it. So that's the reason we have initiated this entire content. This FNOP Charcha is one of the part of those content. Okay, so it seems that Sanka is busy somewhere, maybe. Okay, fine. So let's move that. Let's not wait. Okay, so Raghunath ji, so first of all, thanks a lot for joining us, right?
Yeah, my pleasure, and thank you for inviting.
Yeah. Okay. So let me start with the basics. Obviously, it's a formal question for all our speakers, right? Our user just want to know that how your trading journey have started, where you come, why you have created this platform, right? What is the brain behind it? What is the rationale behind it, right?
Okay. So actually, my entry into trading journey is an accident.
Okay.
So I started my trading journey in 2011. So it's a little bit more than a decade now. So I was due to a medical issue, I was bedridden for 6 months or so. So at that point of time, I didn't know what to do with my time. Like I couldn't do any work at that point of time. So I got in touch with my cousin, and he was a sub broker to, I think, one of the brokerages, and he introduced me to this all these features and options. And imagine this, a decade ago, I didn't know anything about the features or options. So, and I got curious, and I had all the time at that point of time. So I started exploring, what is this feature and what is this options and all those things. And I learned something from him. I learned some trading strategies, and without thinking twice, I jumped into trading, and immediately I lost some money. So it's kind of admission fee for entering into the trading. So so that's how I entered into this trading journey. But as we as I went through my trading process, learned my lessons of what to do, what not to do, and how to do trading more systematically. So I was looking at different kinds of tools. And at that point of time, 2011 to 2015, The only way to do all these, calculations of what is the profit, possible profit or possible loss, the only way to do was that using Excel sheet. There was no other alternative. Later, some tools came, but they were not very polished, and there are some data issues and all those things. So, my frustrations with these tools at that point of time, around 2016, 2017, that I started creating these Obstra. The name was not Obstra, but I started creating these tools, how to calculate implied volatility. So, like, 6, 7 years ago, there was no tool available where you could calculate the implied volatility. Now there are, dime a dozen. So that's how, out of my own requirement as part of trading process, I created Obstra. And then at some point of time, I shared with more people, and more people got interested. And that's how we created this huge platform. So that's my story so far.
Great, great. Hi, Raghunath sir, this is Shankar here. I'm a
Shankar, there is
part
lot
of
of echo coming from
the.
your end.
I'm a part of the training team here in Paytm Money. So, sir, my question to you would be: how important is open interest
Okay.
for analyzing?
So, yes. So I mean, if you ask any Gujarati trader, or even any trader, they will say Bhav is Bhagwan, right? The price action is a god when it comes to
Correct.
trading. So the open interest is the right hand of that god when it comes to trading, and especially in derivatives. So as always, price is the most important part, and the secondary part will be the open interest when it comes to options or even futures as well. So you can use open interest to confirm what you have analyzed using your price analysis. Let's say your price action analysis tells you uh, that there is a bullish signal. Now you can confirm that signal using open interest, and you can be more confident that okay, now these two things align, and therefore you can be much more confident than just price alone. So that's how I would put the role of open interest analysis in trading. So don't use it as a standalone, but use it as a secondary confirmation signal.
Okay.
Right, right.
So that's great. Yeah. So Raghunath, you have started your Obstra. So
Yeah,
this tool you have started for yourself, right? You are a trader, so that is the reason you build this tool for your trading purpose, right?
yeah, exactly. So as I said, a while ago that some 6, 7 years ago, the only way to analyze any option strategy was through Excel sheet, and that was not very perfect in the sense. So that's the reason I had to create this tool so that I can do much more better analysis of looking at these different option strategies, and to make adjustment to these strategies, and how it looks after you make adjustment. So these things were only possible after I started making my own tool. Of course, there were tools available in the foreign markets for the foreign, like US markets, but was not available for Indian markets at that point of time.
Okay, right. So yeah, that is the background. Maybe you are a trader. That is the reason. It's a wonderful tool. Even I am using as Alok also using that tool.
Yeah,
So my
thank
question
you.
is related to today's topic. What is more important? It's the OI or change in OI?
I would say both are important, open interest as well as change in open interest. So open interest will tell you what is the scenario so far in the market. Okay, like whether the market is bullish or it's bearish. And the change in OA tells you what is happening to that scenario. or how the scenario is developing in the market. So if you are a trader, I would give more weightage to change in OA because that's what you will look at when you are, when you try to bet on the market when you're trading, right? So, but both are important, both open interest as well as change in open interest. And for those who don't know what is open interest, that open interest is nothing but the uh, like the trade that is open in the market. So there is one seller, one buyer, and they both open a trade, and that is the open interest. So like that, there will be many traders who take opposite positions and create this open interest. And their interaction will tell you like what is happening in the market, whether is it bearish or it is bullish, depending on how the open interest is developing. And so one more thing I wanted to add is that so when you look at open interest, like when you want to analyze open interest, uh, so there are people who look from the perspective of an option buyer, and there are people who look from the perspective of an option seller. And in my view, I would give more weightage to look the open interest from the perspective of an option seller. So why? Because the option seller is risking more when he is generating this open interest, right? Because he has to furnish more margin in order to to create this open interest, and buyer has to buy and he has to pay only the premium. So you can imagine that there will be traders and there will be institutional traders or even prop desk or high net worth individuals who might be have a lot of money and smart money, who knows what they are doing, and they are willing to bet a lot of money when they are selling their options. So if there is some activities taking place in the market in terms of open interest, so you have to look from the perspective of the seller, but not the buyer. That's my view. So there can be an opposing view as well, but that's what I would like to interpret open interest in that perspective. That look from the eyes of an option seller.
Right, sir. Sir, tell us.
Shankar, there is a lot of echo from your.
Okay. Is it better now?
Yeah, it's better.
So, sir, my question to you is, how do we interpret open interest at certain strikes? So, where you have the most highest open interest at, let's say, 16,000 put and so on.
Okay, so now open interest, as you know, depending on the index or the stock you choose, some can be liquid, some can be illiquid. But when you look at the liquid options, like in the case of Nifty or Bank Nifty, now you can look at the different strike prices, and different strike prices have different kind of open interest, right? But the highest open interest, more often than not, will be at the money strikes. More often than not. There will be some exceptions, but more often than not, it will be at the money strikes. So, for example, today the market is around 16,250. So, so you have to look at the open interest around 6,300, which is the most liquid strike closest to that particular price. So those are the at the money strikes are the most important open interest that you have to focus on, because what is happening there will tell you where the market is going, because that's where a lot of open interest is built, and that's where a lot of exchange of open interest happens, whether in terms of covering their open interest or either in the building up of the open interest. So at the money strikes are very important in that from that perspective. Now, how to interpret? So if you build, uh, so let's count an individual open interest in this case. Let's say I want
Yes,
to look.
that was something which I wanted for individual open interest and individual strikes.
Yeah. So, for example, let's say we'll take 16,300 strike of 10th March expiry. Okay, because that is at the money strike at this point of time. Now, at this point of time, the put option open interest is more than call option open interest. Now, when you look from the perspective of an option seller, the put open interest is more than the call open interest. Now, you have to remember that when the put open interest is more, it means that at this point of time, the option seller is confident that 16,300 will act as a support. Okay, because if he is not confident, he would cover that open interest very quickly. As the market goes down, he will cover that open interest very quickly. Now, the same way, if the call option seller is very confident that the market is not going to go above 16,300, then he will increase the open interest at 16,300. So this is a fight between the option sellers of 16,300 put and the option sellers of 16,300 call. And they will keep on fighting until one of them gives up. So you can look at this particular open interest chart. So you can actually plot this chart of both 16,300 call and 16,300 put, and you plot for today. You will know that in the morning what happened is that the open interest of 16,300 put went below the open interest of 16,300 call around 10 a.m. Right? When at this point of time, what happened is that the market, sorry, 1 minute. Okay. So around 10 a.m., what happened? The market suddenly fell down. So the put option writers or the put option sellers, they have quickly covered their 16,300 put. Okay. But at later point of time, around 11:30, when the market has went to around 16,171, around 11 a.m., they started building up their open interest again. And by 12:45, they crossed the open interest of 16,300 call. And at this moment, when the crossover has happened, the Nifty went from 11 a.m., it was around 16,171. And by the time this crossover has happened, of the open interest of put above the open interest of call, the market went to 16,346. So now you know, depending on how this building up of open interest is happening, you know what is happening in the market. So that's how you can use this interpretation of these open interest charts to take bets on the market. So if the open interest of the puts are increasing, then you can be confident that the market is going to go up. And the same way, if at the same time, if the open interest of calls are coming down, then you can be even more confident that the market is going to go up, because the call seller is giving up and put writer is getting confident. So you're bullish at that point of time. So that is how you interpret the building up of this open interest. Now,
and individual strikes. And sir, what question is? Yes.
Yeah.
And my next question is on the same lines.
Yeah.
Like as you said that you need to keep monitoring.
Yes.
So what is the ideal time frame of monitoring? Is it 15 minutes every half hour? What is the ideal time of monitoring this?
So it depends. It depends on what kind of time frame the trader is more interested in. So if you're like somebody is like full-time trader who's always looking at the market, 5-minute time frame is good enough. But if you're somebody casually looks, every 30 minutes or so, then 30-minute time frame is good enough. So it depends on what kind of time frame you're trying to invest on. So if you're intraday trader, for example, a 5 minute is good. If you're a positional trader, then 15-minute time frame is good. And so this is at individual strike level, like how these things are building up, right? So now this individual strike also comes into picture when it comes to supports and resistance. Let's say we did some kind of technical analysis. If you did some kind of technical analysis on Nifty, uh, and you say that okay, that this particular level has acted as a support previously because it touched previously and took support previously. So there's a chance again that it might take support at that particular level. So what you can do is that when the market goes down there again to that particular level, then open up the chart for that particular strike of both put open interest as well as call open interest, and see what is happening there. So if there is a support at that particular level, then you should see a buildup of put options open interest, and you should see the covering of the call open interest. So the call open interest should go down and put open interest should go up. So then you can say that, okay, the market is kind of trying to take some support. So that's how you can do this kind of individual strike analysis at supports and as well as at resistance. And the resistance, the analysis exactly opposite. There, the call open interest should be increasing and the put open interest should be coming down for that particular level to act as resistance. And if you have to look at overall open interest, what is happening to them at the overall level. Now, in Offstar, there is one particular tool where we track the open interest build up at all the strikes. So, what do I mean by open interest build up? So it means that
Is it change of open interest?
Yes, exactly.
And
as well as
referring
price.
to the change? Yeah.
Yes,
Okay.
as well as price. So
rise in open interest, rise in price of a certain strike price is call and put, right? That's
Yes.
Yeah.
Okay. So for those people who are new to this kind of open interest analysis, there are 4 kinds of interpretation for open interest build up as well as price of the option. So if the price of the option increases and the open interest of the option increases, then we can say that there is a long build up in that particular option. So it can be call option or it can be put option, it can be anything. So there's a long build up in the that particular option, not the underlying, but that particular option strike and that particular option.
And now, that particular can even be a call or a put. It can be 16,100 call or 16,100 put as well, right?
Yes. So we have to do individually. So call is separate and put is separate. Okay. So at the same time, for example, currently, if you look at the open interest, just a moment, that there is a short build-up in the open interest of the call options. There's a short build-up in call options and a short covering in put options. So before going to there, at the same strike. So let me explain what is the actual build-up here. Right? So as I said, rise in price of the option and increase in the open interest. It means there's a long build-up in that particular option. So it can be call or it can be put. Now, if there is a decrease in price as well as decrease in open interest, then there is a long unwinding in that put option, the option. So it can be put option or it can be call option. Now, if there is a decrease in price and there is an increase in open interest, then there is a short build-up. Okay? Because there are a lot of people who are selling options, so the price is decreasing because there is a huge short build-up, right? So that is why the open interest increases and the price declines. Now, the fourth one is short covering. In the short covering, the price increases and the open interest decreases. Now, this happens when the option seller is threatened. So let's say I wrote a put option and suddenly market fell. So I am under pressure to cover that put option. So what I will do, I try to quickly cover that put option. So what happens? There's a demand for that put option for buying. So the price of the option increases and the open interest decreases. Because when you cover your option, the open interest decreases. So that is short covering. So you have long build up, you have long unwinding, you have short build up, you have short covering. So long build up and short covering are bullish for the market. Long unwinding and short build up are bearish for the market. Now I'm looking at this overall build up of the options of both call options as well as put options for 10th March expiry of Nifty. Okay. Now I see that there's a huge short build up across all the options in the call options. There's a huge short build up. So there's a huge short build up in call option means that the sellers, option sellers, are confident the market is bearish and therefore they can gain that premium by selling more call options. At the same time, there is at the close to these at the money options and in the money put options, there is a huge short covering, which means the option writers, the put option writers, are close to the money are threatened that the market is going down, so I want to cover. So they're quickly buying the options to cover their positions. As a result, there is a short covering. So the price is rising of the put options, and at the same time, the open interest is decreasing. So just by looking at and on the out of the money put options, there is a long build up. So there are more people buying put options either as a hedge or as a speculation that the market is going to go down. So just by looking at this open interest build up, you can say that at this point of time, the market is bearish, just based on open interest analysis.
Thanks a lot, Raghunath, sir, for the detail of OY data. So, guys, we are anyways doing this OY analysis discussion from so long. I think probably you get a lot of more insights and a lot of more analytical detail, right?
Yeah.
Now, okay, let's move to the next one. So now we understand the OI part and option pricing part.
Yeah.
The another important part. Yeah, sorry. The another important aspects we just our user want to know that how important is IVs, implied volatility, right? And the role of implied volatility. Yeah?
Yes. So implied volatility, for those don't know, is nothing but it's a proxy for the pricing of options. So if the option prices are very expensive, then implied volatility will be very high. So for example, if you look at the current VIX is nothing but the implied volatility of the Nifty. So if you look at the Nifty implied volatility, it's currently around 27, right? And briefly, last few days, it went above 30 also. So what does it say is that the option pricing is very high at this point. They're very expensive. So why it is very high, the options prices are why they are very high? They are very high because there is a huge uncertainty in the market. And usually when there is a huge uncertainty in the market, there's a huge demand to hedge the positions, either from institutions who want to hedge their stocks or who want to hedge their positions, the mutual funds or the fund manager want to hedge their position, right? So they want to hedge their position, so they buy a lot of options, put options in this case. So there's a huge demand for put options. So they're very expensive at this point of time. So because of huge price, the implied volatility also increases as a result of that. So implied volatility is nothing but the volume weighted average of the implied volatility of individual strikes of both put options as well as call options. So that is the importance of volatility. It tells you how expensive the put options, how expensive the options are, as well as it tells you how uncertain the markets are. So if the markets are very uncertain, then the implied volatility is very high. And another way of interpretation of the implied volatility is that higher the implied volatility, it is implying that there will be huge movements in the market. Okay, that it is implying. So that is it's for implied volatility because it is implied from the option prices as seen in the market. So that is implying the option prices are implying that there is a huge volatility in the market. So that's exactly what we are looking at, right? The market is very volatile. So it goes up 100 points, it goes down 200 points, again comes up 300 points. So it's very volatile, the market. And that's exactly the options are indicating. So that is why the implied volatility is very important because it tells you how the market participants are looking at this market. Whether is it uncertain or it is very certain. So that's exactly implied volatility is important. Now there are more there. If I can add some more points there. Now,
Please.
so implied volatility under normal times, what happens is that just a moment.
Friends,
Okay.
if you have any questions, queries, doubts, feel free to write to us in our messages, and you can DM directly message us. We will ask Raghunath sir from here.
So also one more important thing that people have to remember is that so when the implied volatility is very high, it's a good time for you to reduce your positions because it's very uncertain. The market is very uncertain. So if you're trading positions, trade light. That's also a very good signal for the traders. Yeah, you can proceed for the next question. Hello.
Yeah, Raghunath sir.
Yeah.
You have explained about implied volatility.
Yeah.
So every strike has its own implied volatility, right? IV. It's a different implied volatility.
Yes.
So how can we interpret and how can we use this for as a trading opportunity? Can we use this on the basis of this? Can we execute any trades? If yes, then what kind of trades we can execute?
Yes. So as I said already that when implied volatility is very high, it's a good time for traders to trade very lightly. And this is especially true for trades which are which involves shorting volatility. Because what happens is that when there is a volatility expansion, we don't know where this volatility expansion will stop. For example, when this corona has happened, the volatility, we have never seen that kind of volatility in our lifetime, or at least in my lifetime. So we thought, I thought that, it might go to up to 30, 40 and then it will come down. But it actually went up to 90. So you never know how high this implied volatility can go up. And if you're in a short volatility trade, like when you sell an option, which is a short volatility trade, you don't know how high it can go. So it's important for short volatility traders to be very, very careful when this implied volatility is expanding. So if you have any trades, any strategies that involve short volatility, then use only risk-defined short volatility strategies. So in this case, strategies such as iron condors or iron butterflies are better than the short straddles or short straddles, which are very risky at this point of time because we don't know where the volatility is going to stop. And so this you have to keep in mind. And so this is the first part. So what kind of trades one can take? As I said, iron condor and iron butterfly are kind of ideal strategies if you're going for short volatility strategies. But and the other part is that when the volatility is very high, and the best strategy is where you have a directional view. So you have to take a directional view, whether market is going to go down or market is going to go up. Now this directional view you can take depending on your own analysis. It can be from any of indicators or price action, moving averages, or plus open interest analysis. It can be anything. So but take a directional view, and then accordingly you take directional strategies. And another important point here is that when the implied volatility is very high, and if I'm taking a directional view, don't buy options. And especially when the IVs are around 25 and 30, right? So I'll tell you why. Because if you buy options, let's say you have an assumption that the market is going to go up and you bought a call option. Now, there will be a scenario where you bought a call option and the market went up 200 points and you can still be in loss because the options are very expensive. And when the market went up, there is a volatility crash in the market. The volatility component of that call option has went down. And despite that the direction is correct, still the call options have went into loss. That kind of scenario happens quite frequently when the implied volatility is very high. So you have to be very careful when buying options when the implied volatility is very high. And that's where this individual implied volatility comes into picture. Okay, so you have to look at each and individual implied volatility of the option strike and decide whether, okay, buying this option, this call option makes sense or not. So that's
So in simple language, if someone has to buy, sir,
yeah,
the options in such cases, like when the implied volatility is so high,
yeah.
is it not better that we get into at the money or in the money options for buying, for buyers? Will that make more sense, sir?
Yes. So in the money makes sense because there the volatility component is slightly less compared to an at the money or even out of the money option. The volatility component is very high in at the money and out of the money options. So slightly in the money options are better if you have to buy options, if you are forced to buy options at that point of time.
Yes.
And another point is that instead, if you still want to buy and you don't want to sell option, then go for directional spread strategies. So, for example, we can do a credit spread or a debit spread, depending on. So, if you are bearish, do put spreads, for example, put debit spread. If you are bullish, then do call debit spread, like that. So the spreads take out the volatility component. So even if there is a volatility drop, you will not suffer so much compared to a plain buying of call option or put option. So it is spread strategies will protect you from that risk of volatility in this case, both on the downside as well as on the upside. And
right, sir.
So one more thing I want to add regarding this individual option strikes is that, so what happens is that when the market is very bearish, the at the money put options volatility implied volatility will be low compared to uh, implied volatility of out of the money options. Okay, and if you look at this curve of the implied volatility of the call options and put options, under normal conditions, you see a smile. Okay, that out of the money options have high volatility, and at the money options will have low volatility for both and call and put options. So you see a smile. It's called volatility smile. But when the market is very bearish, then what you see is that these the implied volatility is much higher on the put side compared to the call side. So you get something called what we call as a smirk, a volatility smirk, or a volatility skew. So so we call it as a volatility skew. So in this case, what you can do is that another strategy that you can do is a calendar strategy. So what is the calendar strategy is that if you look at two individual strikes of two different strikes of two different expiries, for example, 10th March expiry and 17th March expiry. Okay. So what happens is that in certain conditions, the implied volatility of the near weekly expiry will be much higher compared to next weekly expiry. So let's say a 16,000 put option, for example. I'm just looking at that option. Is the implied volatility of 16,000 put option is around 32 of 10th March, and 17th March is around 30. Okay. So what we call this as a backwardation of implied volatility. Backwardation means the current weekly expiry, or it could be for monthlies also. So the current weekly expiry IV is much higher compared to the next weekly expiry. And you can do these calendar trades where you short current weekly expiry and buy next weekly expiry of the same strike price. Okay, when there is this difference in IV of of the same strike of two different expiries, short the current weekly expiry and buy the next weekly expiry of the same strike price. So this we call as a calendar spread. Okay, but this you have to do under only one condition: when the difference between their IVs is more than 20%. So, for example, I talked about 16,000 put option, right? So 16,000 put option is 30, or let's assume that it's around 30. Then the difference should be more than 20%, right? So 20% of 30 will be around 6 points. So the difference should be more than 6 points between the current weekly expiry and the next weekly expiry. Then only you can do this kind of calendar spread strategy. So the idea here is that we will benefit from the time value of the current weekly expiry compared to the next weekly expiry. So that's the idea of this particular calendar strategy. So this is for a little bit advanced users, I would suggest. So always look for that 20% difference in IV between these two expiries for that particular strike price. Otherwise, don't do that particular trade, because this is usually a long volatility trade. But under this high volatility conditions, we can still do this trade only under this condition, that the difference in volatility is more than 20%. Yeah.
Okay, sounds good. I mean, the point taken.
Thank you, sir. This is very nicely explained.
Yeah, thank you.
Okay, so now, Raghunath ji, so obviously from the concept perspective, we understand most of the part, even our user understand well. Now come to the straightforward question, right?
Yeah.
So as an option trader, obviously few people are buying option, few people are selling option, right?
Okay.
As you have earlier mentioned that seller options have a higher risk.
Yeah.
Most other retail prefer to buy option, obviously,
Yes.
because they assume that they will make more money, 4x, 5x, versus seller have a limited premium, right?
Yeah.
So from a start, say today I'm starting as a trader.
Yeah.
What should be more profitable? I mean, though it's not the right question, but it's coming from one of our user, right?
Yeah.
So we just want to know that which is the best way. So buying option or selling option, and why?
Okay. So, I mean, this is a very old, very kind of old question, and it is frequently asked question. That's because, especially from new traders, because they don't know which way to go. So, probabilistically speaking, selling options have uh, more chance of winning than buying options. But it doesn't mean that you don't buy options. It means there are specific scenarios where you have to buy options. And there are specific scenarios where you can sell options. Okay? So when you have to buy options. Now, so when you're a new option trader, when you don't have many lot of capital and you're just testing the waters. And as you said, most of the people will try to buy option because that is the easiest way to get an exposure in the market. And obviously, the returns are oversized if it works in your favor. But realistically speaking, and these are many studies have been done that up to 70 to 80% of the time, the options go worthless. So 70 to 80% of time, there is a high chance that the option seller wins. Okay, so why there is a problem in buying options, and when you have to buy options? So that I am going to clarify here. So what are the problems with buying options? So three things have to work in your favor. For the buying an option has to go in your favor to get a profit from buying an option. So what are the three things? One, your timing should be perfect. So that we call in Greek terms we call it as theta. Okay. And then two, your direction should be correct. Okay. In Greek term we call it as delta, directional exposure. And third, the volatility you should be in the correct side of the volatility, which means the volatility has to go in your favor. Either it has to increase or it can stay at the same level. So three things are working against the buyer of an option. So these three things have to be in your favor for you to benefit from your buying the option. Okay. So when you can have that confidence that all these things will work in your favor, one, buy the option when the option premiums are reasonable, either very cheap or reasonable average price. Don't buy the option when they're very expensive. Of course, there are exceptions, but most of the time, so always that's where the IV comes into picture. That when the IV is, reasonable level, average level, or below average level, then it makes sense to buy an option. If you're a directional option trader. Now, two, your direction should be work in your favor. So, whatever strategy you made, or whatever indicator or trading signal that you're using, should be good, and that you're confident that that signal has very good confidence. So, if you have good confidence, then there's a good confidence that your buying the option will work in your favor because it has to go in your favor, in your direction. Otherwise, you'll be in loss. Now, the third factor is the time factor, timing. Now, if you buy an option and you sit and nothing happens, even then you lose all the premium. That is because of theta, right? Every day you buy an option and every day there is a depreciation of theta, right? This we call as time value. So every day that option value doesn't increase, you keep on leasing. You can keep on losing the premium. So your direction has to work very quickly. Otherwise, you keep on losing the premium, the time value. So if you buy an option, it has to work within few days, like 2 to 3 days, and then it has to work in your direction, whether it can be bullish or bearish, depending on which option you bought. And three, you bought it at a reasonable price. So if these three things are in your favor, then you can go with buying options. Now that will work only 20 to 30% of time. So be cautious of this particular fact. So trading signal should be very good for you to buy that option. So whether you follow a trend trading signal or whatever it may be. So be very confident of your trading signal. So your buying option is as good as your trading signal. So that's when you have to buy options. And on the other hand, for sellers, there are only two things that are working against that seller. The one thing is the okay, I forgot about the buying option. The another factor is the volatility. So when you bought an option at very high price, and if the volatility drops, even if the direction is right, you will still lose. So that is where buying at reasonable price comes into picture. Okay. And when coming to selling the options, you sell the options when the implied volatility is very high, when the premiums are very high. So you get good enough premium and you get good protection. And it doesn't mean that you just go and blindly buy blindly sell the option just because the IV is very high. That is the wrong way, because we don't know how long the IV keep on increases, right? So you have to always look at the IV of the stock, and you have to sell your options if you're an option seller only when the option implied volatility is coming down. Okay, the curve is coming down, not when it is going up, because we don't know when the this curve will stop when it is going up. So always wait for it to turn, to give it a U-turn, then only sell options. So that is one factor that option seller has to keep in mind. Sell options when they're expensive and when the implied volatility is coming down. And two, the option seller also has the directional risk. If the market suddenly goes up or goes down and it gives a huge gap up, like on 24th we had like 5% down move, right? Almost 5% down move. So that kind of risk can blow your account if you are an option seller. So to be extremely careful when you are selling options, it's always better to buy a far out of the money hedge option, because at least even if you lose a lot, at least you will not blow your account for the option sellers on the suggestion. So that is directional risk you still have, but compared to a option buyer, that there is some protection for the option seller in terms of direction, because you are getting premium when you are selling, right? So that will afford you slight protection when you sell option, very slight, not much. And the third one is the time factor. While the time factor acts completely against the option buyer, but the time factor is a friend of an option seller. So even if nothing happens in the market, then you still benefit from selling an option. So keep all these factors in mind when you're buying options and when you're selling options. So these factors are very important. Yeah.
Right. Raghunathji, as of now, there is a lot of volatility.
Yeah.
VIX is also more than 27 or 28 now.
Yeah.
And option prices are also very expensive now.
Yes.
So all the movements happens with the news, not with the any data. We can say if there is any news comes, then immediately prices are moving,
Yes.
maybe upside or downside.
Yeah.
Right?
Yeah.
In this scenario, it's a bit risky scenario for traders also.
Yeah.
A difficult scenario for them. So what is your advice? What kind of strategies we can do, and what is your some final advice for our listeners?
Okay. So here, two things I suggest is that, of course, with all standard disclaimers, that if you're a directional trader, like you have a trend trading system, then you go with your trend trading system, then you take out the risk of very expensive options, and you still want to be directional, then you do debit spreads or credit spreads. So in a high IV scenario, the credit spreads are better than debit spreads. They're slightly, high IV conditions, credit spreads have slightly more advantage than a debit spread in terms of IV factor. And if you're a directional trader, okay, and if you're a non-directional trader, because everything is flowing with news, so nobody knows what is happening, right? It can be very volatile, and it might be still in a big range, right? So if you're, what you can do is that you can do a defined risk strategy where you sell volatility, because the volatility is very high. You take a defined risk strategy here. So if the volatility goes down, you can still benefit from this strategy. And as the time passes, obviously, you benefit from this strategy. And the strategies being iron condor. If you want a huge range, go for iron condor. And if you are working with smaller ranges, then go for iron butterfly. The difference being your profit, the maximum profit will be much higher in the case of iron butterfly compared to a iron condor. But again, it all comes to risk reward. So there is a high probability of profit in the case of iron condor, and slightly lower probability of profit in the case of iron butterfly. So depending on if you are non-directional trader, iron condor, iron butterfly. If you are directional trader, go for credit spread strategies.
Okay. So great. Any final advice, sir, you would like to give it to our audience here?
So final
Your
advice,
last 1 minute,
yeah,
which we have to keep it as your final advice.
yeah. So basically, I mean, if you're a new trader, I would still say trade very small, trade often, get some experience in the market. Don't put too much money in one go. For the new traders, that's my advice. And for the seasoned traders, I mean, what can I say? Is that don't over leverage yourself, because leverage is a big killer of the accounts. So be very careful with taking more leverage, and always have some cushion in your account. So what I observe with some people, who write to me is that they use up all the money in their trading account. So they want to benefit from all the money available in the trading account. They don't leave any leeway if something bad happens in the market, that they can rescue their position. Or see, what happens is that sometimes then the volatility increases, the margin charged by the exchange also increases. So imagine that you are an option seller, and suddenly the volatility increases, the margin also increases. And if you're somebody you didn't have that cushion, then you will be in trouble. You will have a margin call, and you cannot take any, like, even if you want to buy a hedge, you will not be able to buy a hedge in that case, in that scenario, to protect your option selling position. So I always suggest is that keep some room in your trading account. So most of the time, always do 60-40 or 70-30. So use around 60 to 70% for trading, and remaining 30-40%, keep the powder dry in case something bad happens, to rescue your position, or if you have to do some hedging, or if you have to do some adjustment to your strategy. So any of those things. So that is my advice.
Thanks, Raghunathji. So, guys, I'll take 30 seconds to just summarize what we have discussed today, right? So, the first point is from importance of OI, standalone will not much value. Use for your secondary confirmation, right? And OI weightage should be more for a seller size, since high risk compared to buyers. That is one point we have discussed in a detail. Then there is an importance. I mean, importance of OI and change in OI. So the both are the important. It depend upon the kind of scenario and what kind of market you're looking for. For a trader perspective, if you observe, they are more interested for the change in OI. From a OIs till today, what is going to be happen as per this particular contract? Obviously, both will give you the same perspective. But change in OI will be for the immediate action, which is important for us. Another point which we have discussed from a strike-wise perspective, that how to interpret, though detail is already given by Raghunath. Just one point: at the money strike price is more relevant, though we have given the similar perspective multiple times. Another important point regarding to time frame, it depends upon what kind of time frame you are working on, 5 minutes, 10 minutes, or 15 minutes, all this work. Just to add one more information, same heat map and oil analysis, you will also get the FNO dashboard for a paytm money. You can go there and check. Now next point we have discussed regarding the IV. Uh, so there is one important aspect. uh, Price is high because of very high uncertainty. So these both are related to implied volatility only, right? Now coming to the this when IV is going to higher, huge movement into the market. So that's the resultant or result coming from the market, right? uh, One more, these IVs are important while you are entering into the market. So it is another jargon or another data which you need to learn. Okay. So just to go more on a deeper side, obviously we have already provided some input, but go into the deeper. Uh, One important aspect which Raghunath have mentioned, that when IV is higher, it's a perfect time to reduce your position, so you can minimize the position. Now, another point we have discussed regarding the interpretation of IVs. So you have listened multiple times. There are multiple option seller who are doing straddle selling and getting a premium, right? So selling straddle, obviously you'll get as a seller. It's a more often and more known strategy. Multiple people are doing. But if you want to play with the lower risk, go with the iron condor or go with the iron butterfly, which is again it's a short wall strategy only, right? And you will get the limited exposure with the limited risk and limited return rather than open risk, right? That's one important part. Now the last point is buying option and selling option. Obviously both are dependent upon what kind of trader is. For example, I am a buying option side, but the probability of a seller is 66%. As simple as that. It's a pure probability math. Now when there is a lower capital, and if you want to test, option buying is the perfect example. But as Raghunath has mentioned, that please go with the cheaper option, which will result in will be lower losses and higher opportunities. uh, Obviously there are dependencies like timing should be perfect, direction should be perfect, wall should be in your favor, right? So there are several reasons when you are making money. One additional important data I just want to add: if there is a big event going to happen, option buyer have a larger perspective, larger opportunity compared to there is no event. Because if there is no event, by default your theta decay is there, right? So your option is going to be decrease and obviously 10 to 0, right? That's the one important point which you have discussed, right? Anything I'm missing, Raghunathji? Anything?
Yeah, no, yeah, it's perfect.
Okay, perfect. So I'm just noting down for my users so that they can summarize, because there are multiple users who join later or maybe
Yeah.
some missed because of network issue. Yeah. Okay. Thanks a lot, guys. Thanks a lot for joining Finope Charcha. We'll keep continue these events and try to invite such speakers. I'm sure that Raghunath will invite again for some other topic to Raghunath to add more value for our users.
Yes, and most importantly, Alok, I think thank you, Raghunath ji, for sharing so much of insight. I think this was one of our best with your over 2 decades of experience. You summarized most of your learnings in just 1 hour session, and that's even quite amazing. It was really amazing for all of us to learn from your 2 decades of experience.
Right.
Friends,
Thank
you, Alok. Thank you, Peter. Thank you, Raghunath ji, of course, and all you lovely audience for attending us. Keep following us on Twitter, so you'll get updates on newer events and different kind of programs which we keep on doing. And for any queries and doubts, you can write to us. And last but not the least, yes, as a formality, let me also share this, that whatever we shared here is only and only for learning purpose. These are not advices. And please check your risk appetite and your knowledge and your financial situation before you trade in options. Thank you, everyone.
Thank you.
Thank you, Alok.
Thank you, guys.
Thank you.
Thank you. Thank you. Bye. Have a great evening and weekend. Bye-bye.